Okay. So yeah, let's see if this person, this another person I'm expecting to join. I'm not seeing this person joining, and I don't know. Okay. So we have someone new right now joining us. Okay. This man here with an HP. His name is I'm beginning to pronounce the name, bro. Yeah. So what's his name? Where is this guy? Yeah, Tauha. Something like Tauha. I don't know. I don't know how that's the correct pronunciation. Yeah. So so I want us to get interactive. Please, let's all unmute. Let's unmute. Let's unmute. I want us to talk. I want us to talk as we are going into the details. So I want everyone to be able to actually say something. Yeah. Hello?
Hello?
Yeah. I'm asking about the others. Let's unmute so that we're able to talk before we can get started. Yeah. Please unmute.
Yes, I unmute myself.
All right. Okay, great. Tom, maybe you can tell us a little bit about your experience so far. Like how has it been for you? Can you tell us a little bit about your experience trading so far?
Like trading, I know so many things, but consistency is the big issue for me. And the other thing is the bond ratio, because
Yeah.
so I'm looking for a strategy which has a very good because most of all, and in this
Though we can hardly hear you. Can hardly hear you. Are we able to get you clearly?
No, it's breaking kind of. Like he's in front of a TV or radio, that's fine.
Yeah, you're kind of breaking. I don't know if we can't get you clearly. Anyways, yeah. So I need questions before we can get started. Do you have any questions for me? Any questions? Let's get before.
Yeah. I think I have a question, though it's maybe a bit fast forward. What is MFA, that new thing that you've posted there? Or maybe that should come later.
Oh, so MFF is my Forex fund. It's my Forex fund. Yeah, it's a prop firm. It's a prop firm that that funds traders. So especially those people that want to, one of the challenges that we have as traders is capital. Most people don't have enough capital to trade. So if you have the skill and if you think you can make it, those people actually you can buy a challenge, a program. So like for me, I've bought the challenge right there for $84, which is $10,000. And then when I trade that $10,000, I have to make profits of about I have to make profits of about 8%. Is it 8% here? And then my drawdown, meaning my risk per day, my maximum risk is supposed to be like 500, and then my profit, the profit target is about 800, and then the overall drawdown, which is 1,200. And then once you pass it, there are two challenges, and then you'll be able to. They'll give you a live account, which you can able to trade now. After you've traded, and then whatever profit you're going to make, you're going to in the first month you get about 75%. Then going forward, like that it goes up to 85%. So the profits, you're able to get all the profits and then just share like that. 85% you get, and then the rest is theirs. Provided don't breach any of their rules, you'll be okay. So for those who have the skill already, it's actually a good thing. You have the skill, but you don't have enough capital. That's actually a very, very good thing to actually attempt. But first of all, you need to have the skill, right? So Munya, you're welcome. Chimunya, you're welcome. Kindly unmute yourself. So I want us to get talking.
Thank you so much. I'm sorry for the late joining of the group. I was held up somewhere.
Okay, great. It's good that you joined. Yeah. So I hope I've answered your question, Andy.
Yes, go on. Okay. Yeah, kind of.
Yeah. So when you've gained the skill, it will be actually, it's a good thing that you can actually do. All right. So until you have the skill, then yeah. So personally, I'm starting on Monday. So let's see how it goes. So I'll be trading a $10,000 account with the hope of trying to make some good money out of that. All right, I think we are now 7. I think we are now okay. We can start the meeting.
Okay.
Yeah. So kindly unmute. Yeah. We are all welcome. And what I ask from you guys is total participation. Let's be able to participate. Let's ask questions where we're not clear. I know some of people who are joining us today are completely new. So Nchimunya, please, I know you might have a lot of questions, but right now, yeah, just get whatever you can get from here, and then you can build up from there. Okay. Yeah.
Okay.
Great. So let me first start by asking a question. For those of us that have been trading for some time now, what do you think is the major cause of people failing? By the way, did you know that 90% of traders fail? Did you know that? Did we know that 90% of traders lose money?
Yes, I know that.
We know that, right? Okay, good. Now we're able to get you clearly. Awesome. Yeah, okay. So yeah, about 90% of traders lose money consistently. All right. So what do we think are the causes of that? What do you think causes people to lose money like that? So let's get interactive. Before we can jump into this.
Because they're not consistent. They lose money because they're not consistent with what they are doing. Once you are consistent, you come up with a strategy and be consistent with it. Be sure of what you are doing. Do it, practice consistently. Then you won't be losing, even if it's a probability, but at least once you do, the more you do it, at least the high probability of you winning some trades.
Okay. How about others? What do we think? What do you think causes most traders to lose money in the market? Hello? Let's all unmute. I need us to communicate. Let's communicate. Let's talk. Hello?
Yeah, can you hear me?
Yeah, I can hear you, bro. Welcome.
Yeah. Hey, hello everybody. This is my first time being here. I am so excited, to learn. The reason why traders are losing money is because they try to get rich fast, and they don't want to wait to learn. I can say they want fast money.
True, 100%. That's very true. Yeah. So what else? What other reasons? What other reasons do you think that causes people to actually lose money? My brother.
Yeah, man.
Taha.
Yes. In my point of view, the other is the people are continuously changing their strategies, because once they are winning, they are using that one, and when they lose, they stop it. They don't have believe on one particular strategy. Plus, their risk to reward is not very good. Most strategies has not a good risk to reward ratio. So once they are winning, they continue, but once they are losing, they wipe out their accounts. So that's why they are continuously moving towards the next strategy, and then so on. And they don't have a belief on their particular strategy.
Very, very true. Thank you for that. Okay. So
Welcome.
whatever everyone has said is actually true. Okay. So for those of us who are new, please actually listen and understand, because this is actually true. So most traders lose money. 95% of traders lose money. And then most of them actually end up quitting because of the same thing of losing money. All right. But what most people don't understand is that Forex trading is the game of probability. Most people don't understand. All right. And if you know that it's about probability, why would you want to risk a lot of money on a trade? If you know that the outcome of an individual trade is random, why would you think of trying to risk it all on one trade? Trust me, I've seen beautiful trades failing. I've seen beautiful setups. You have everything ticked out, but the trade still fails. Okay? Take the same trade, yes, tomorrow, take the same trade tomorrow or the following day, you realize that it actually works. It works. You take it like today, it fails. Tomorrow you try it might even fail. Take another trade to find that that trade is going to be a winner. So the thing is, we cannot know which trade is going to win. We have no idea. No matter how much you think you know, you're just lying to yourself. You don't have an idea. What we have is an edge, okay? An edge, which is just simply a higher probability of winning over a series of trades, not via a trade by trade basis, but over a series of trades. So you need to have that mindset. We shift the mindsets from trade by trade basis to a series of trades, and that's how professionals trade. Okay, so we need to think of us as a casino and not like a gambler. All right, because even casinos lose money, but I mean, they don't, when someone wins, they won't worry about it because they know that over a series of wins, they are going to be profitable. Why? Because they put an edge over the gambler. Even if someone wins a lot of money, they will know that over time, that money is going to go back to them. So they don't have to worry. But most of us, once we encounter a loss in our trade, 2 or 3 losses, especially you have those in a row, oh my God. Someone will already be thinking of changing a strategy because they don't have that understanding of this concept. Because most of us, when we get into Forex, we are always trying to win, always trying to win this particular trade. Therefore, that's the reason why people end up like buying several times on a single pair, because somehow they believe that that trade is going to win. There's no way to know that the trade is going to win. Absolutely no way. All right. There's no way to know. So we have to abandon that mindset. We change our mindset. We have a strategy that has proven, we have backtested, and it has shown positive expectancy of over a series of trades. And that's good enough. The good thing about our strategy is that it also gives us a massive risk-reward ratio. We can encounter losses, yes, but over a series of trades, we know that will be profitable, okay? We don't know which trade is going to win, but over a series of trades, we know for sure that we are going to be profitable. All right, so I just wanted to clear that so that we have that clear mindset so that we know exactly what we're doing. It's possible to make a lot of money, but it's also very possible to lose a lot of money if you're not careful. If you're not respecting risk management, trust me, you will end up losing a lot of money and then realizing later that you're supposed to have changed your mindset in the beginning. Okay, so today we're going to look at partly the strategy. I know we've done this with some of you, but others, it will be the first time. Others have watched my videos. Yeah, but for everyone, I'm going to start from the beginning, basically. Okay, so that we have an understanding of what is happening, what is it that we're looking for in the market. Yeah. So for the people that have joined us today, have you watched any? Okay, maybe some have watched our videos. Maybe you have a previous understanding. But what I want to actually understand is, do you have any questions on the Quasimodo strategy before we get started? Sorry?
No, sir. No.
You don't have any questions on the strategy? Hello? Do we have any questions on the strategy? Apart from my brother here?
No. I think your strategy is the best one, you know, and I started getting, seeing things clearly. And if anything else come up while we're doing this Zoom, I will ask. But right now, I don't have any question.
All right. How about my brother Tawa? Do you have any questions on the Quasimodo strategy?
I don't know about the strategy right now, but I saw the charts. So
Okay.
Today is my first class, and I just read a book today.
Okay.
So I know the strategy, but I don't know how you can pick and mark and everything.
Okay. Okay. Great. So,
Okay.
the Quasimodo strategy. It's the Quasimodo strategy. I'm sure maybe some of us know that cartoon, the Quasimodo. That's where it came from. So it's kind of similar to a head and shoulder pattern, but it's not the same. So, first of all, let's talk about this. In Quasimodo strategy, it's actually a smart money concept. Okay, it's a smart money concept, and we most of the times use two types of supply zones or demand zones, right? So we have what we call the rally-based drop supply zone and the drop-based rally supply zone. Okay, so let me just do this. We have, okay, let me just draw for you guys. So rally-based drop in the, so this is RBD, and the DB drop base rally. Then we have what you call rally base rally, and then we have a drop base drop. Okay, so these are the four types of supply zones supply and demand zones that we have. Okay. So these are the four types of supply and demand zones that we have. So the first two are reversal type of zones. Okay. So the first one is RBD, which is rally base draw. Okay. So you have the market going to the upside. Okay. So you have the bullish market, and then you have a consolidation. Okay. You have a consolidation. And then later on, you have a drop. Okay. So this is a rally-based drop supply zone. This is a rally-based drop supply zone. And then the opposite is it's a drop. It's a drop base rally.
Right.
Yeah. So the Quasimodo strategy, it's a reversal kind of a strategy, but you can also find it in a continuation. But most of them most of the time it's actually a reversal kind of a type. So these are the kind of zones that we are always looking for. So this is a rally-based drop and a drop-based rally. So these are very, very important. Let's focus on these for now, okay? Yeah. So this is a rally-based drop and drop-based rally. So according to smart money concept, so when the market goes up like this, right? The market goes up, then at this level here, the market is going to be, they're going to be taking orders at this level. And after that, after the orders have been filled, okay? And then when supply exceeds demand, price is going to drop, okay? So when price drops, the smart money, they cannot take all their trades at once because they have so much orders. Therefore, some of the orders will remain unfilled at that level. And once that happens, we expect the market to reverse back to that level. All right. So there are two types of Quasimodo. There's what we call a quick retest and a late retest. Forget about the quick retest. We are going to focus on the late retest. Why? Because it offers us a great risk-reward ratio and it occurs more commonly, and it's just good, better than the quick retest. So the late retest strategy looks like this. Okay, so let me just draw this. I know you have questions, then I'll get back to you guys. So we want the market to be either in a short-term or long-term trend. All right, see, we remember I said it's a reversal. It's a reversal strategy. So you want the market to be either in a long-term uptrend or long-term or short-term trend, right? And then realize that we have more of sell setups than buy setups. That's how it is. I don't know the reasons, but you expect to have more sell setups than buy setups. If you've been following us for a while now, you might have seen a lot of sell setups than buy setups. Okay, so we stick to that most of the time. Of course, we'll have buy setups that if it meets our criteria, we'll actually take a trade. But most of the times we end up seeing a lot of sell orders. Okay. So, yeah. So this is how it is. So the market doesn't move in a straight line. The market moves in, it forms a high. For example, if the market is in an uptrend, it forms higher highs and higher lows, right? If the market is in a downtrend, it forms lower lows and lower highs. That's simple market structure. So when the market is going up, it will make higher highs and higher lows, higher highs and higher lows. All right. So what we have here is, for example, this is the market that's going to the upside, goes up, it creates a resistance, and then it drops. And then it goes up again to form another resistance at this level. So what happens is this: when we see this happening in the market, this will prompt a lot of retail traders who trade support and resistance, and who also that trade breakouts. They'll be prompted to actually sell this because they will look at it as a double bottom. A double top, sorry. We all understand what a double top is, right? So when the market creates something like this, we'll be like, this is a double top, and you want to sell, right? When the market comes back here, we want to sell. That's how we were taught in the beginning, right? Hello, can I get some response?
Yes, right.
Yeah, so we are taught that once the market gives us a double top, we want to sell on the third, we want to sell when the market retraces, and then, yeah. So what happens is that once the market gives you a double resistance like this, most retail traders will try to sell here. But guess what happens to them? The market goes up and takes them out from there. So when they see double resistance here, they want to sell when the market retraces, and then usually the market will take them out. Okay, and that will act as liquidity. So this level here, this is what we call a dual QML setup. So this is becomes our QML. So QML is simply a Quasimodo level. It's called a Quasimodo level. Okay, so you have that, and then after that, the market goes up and creates what? Creates a higher high. So we have a resistance, which is a high, and then we have a low, and then the market creates what? A higher high right there. So this is the low here. Okay. We have a high, a low, and a higher high being formed right there. A higher high is formed here. Okay. Are we all able to see my screen? In fact, you're just talking on your own. Are you able to see my screen?
Yeah, I see your screen. It's fine.
Yes. Okay.
Showing clearly.
Yeah. So we have the market being in a short-term trend. For example, this is a short-term trend. So you have, so we're almost like 30 minutes in, and we're remaining with about 10 minutes. So we'll join back again. I'll just, once the time runs out, let's rejoin so that we can actually continue. So once the market gives us a high, then a low, then the market gives us a higher high here. What happens is that we are expecting price to break this low here. Okay. So after making a high here, low, and a higher high, we want to see market breaking this low. Okay. So what does a break of market structure entail? What does it mean when the structure is broken? What does it tell us?
Change of trend.
Change of trend, right? Yeah.
Yes.
So it tells us that there's shift in the market direction. There's most likely going to be shift in the market direction. Yeah. So after that, the market breaks this low. So we call this a BOS, which is break of structure. After that, the market gives us what? A lower low. The market gives us a lower low here. Okay, the market gives us a lower low. So we have the QML, we have the low, we have the higher high, and then I've left out this part here. So this part here is what we call an MPL. Okay, an MPL is simply what's called maximum pain level. We call it maximum pain level. So on the lower time frame, it's just a level where there's a lot of rejection, okay? Where the market has been rejected several times, meaning some traders were trying to buy, they get taken out. They try to sell, they get taken out. So that's that level there. So we'll make some other videos on the MPL later on, but it's not, yeah, we can do that later on. So the things that I've just put on the screen right now represents what we call the past. So this is what is done in order to trick us into buying or selling. So we have to make sure that we have these things on the chart. Of course, you're not always going to have a dual resistance. Sometimes you're just going to have a single resistance. Sometimes you just have a single resistance here. Okay. We only have sometimes we only have a single resistance here. Okay, sometimes you have a dual resistance. But let me tell you one thing. When you have a dual resistance QML has a higher probability of working than a single resistance. Okay, so that one adds more confluence and confidence to your setup when you have a dual resistance. Another thing that adds confluence to your setup is the candle that breaks this low here. So you need to find a big candle, a momentum candle that breaks this low here. When that happens, it shows that there's inefficiency there's an imbalance that has been formed, and therefore the market usually has to go back to this level so that it can collect the unfilled orders from that level. All right. So make sure that you have a significant candle here, those nice big candles right here, breaking this structure here, because it tells you that the smart money guys are there, they're involved. Okay, so another thing that adds confluence is making sure that your higher high here is not acting as resistance in the past. Okay, that you have to make sure. Make sure there are no levels that are touching this level like this, where you have the market coming to this level like this in the past. So what you realize that if you have something like this in the past, you realize that it's actually the same thing as having something like this. Do you see that? Do we see this? When your higher high here has several touches in the past, it's just more like you having this level. Guess what happened after? The market takes them out, right? Exactly. So when we have a level being touched several times, it has a less chance of working because it's most likely going to be used as liquidity. So we have to avoid this. So make sure your higher high is not acting as resistance in the past. Make sure. How you do that is you put a line or a horizontal line on your higher high. And when you do that, you zoom out or go to the higher time frame so that you confirm that there are no recent touches in the recent past. Okay, so this thing what we've covered right now is what we call the past. This is the past. So you have to make sure that everything is available in your past. So in the past, what do we have? We have a QML, we have a low, we have a higher high, and MPL can be there or it cannot be there. Sometimes it's not there, okay? So you won't always find an MPL, please. It won't always be there. But when it's there, it's very visible and you can't miss it. So after that, we have a lower low. So remember, this is the past. Are we okay up to that level?
Yeah.
Is everyone okay?
Yeah, I'm good.
Anyone? Let me get some feedback from everyone. Munya, you're saying you're not getting us properly.
Yeah, the reception is bad on my end.
Oh,
so it's really hard for me to find.
All right. Okay, Mr. Mwala and Taha. So are we okay from up to this level?
Yes, I'm fine.
Okay, no questions?
No, right now, no.
Mr. Mwala.
No questions.
Okay, so we are good here. So make sure you have this, make sure this is there. Okay, so the next thing that we look at is the progress. So in the progress, we will have different ways in which the market is going to come to us. We have about 4 ways that the market can come to us. So it can come to us in the form of a fake out, which is my personal favorite kind of setup that occurs more frequently. And the other setup is the diamond setup. The other one is the CPLQ, which is the compression plus liquidity. And you can have everything else combined. Okay. On the fake out kind of setup, we have 2 types. We have what we call a version 1 and version 2. So the one you're seeing right now is a version 1, where we only have market respecting resistance 1, 2, 3. So this what we have here is R1, R2, and R3. So this is R1. R1 simply means first resistance, second resistance, and a third resistance. Okay. Sometimes you can have just 2 resistance. Sometimes you even have 4 resistance. That doesn't matter. Okay. Make sure you're able to identify this as your resistance. And like just like I was saying here, once retail traders see this aligning, they already want to sell from this level. Actually, we are told that when you have two touches, the third touch, you sell, right? Am I right? Those of us that have traded support and resistance.
Yes, yes, absolutely right.
Definitely.
Yeah. So what you have is you have a setup like this where you want to sell from here and your stop loss is just above, they say 20, 30 pips above the resistance, right? And then guess what happens? The market goes and takes you out. Why? Because they know, smart money guys know that this is a level where a lot of people are trying to sell. By smart money, I'm talking about the hedge funds, the big banks, the institutional traders. They know how retail traders trade. And therefore, when they see a resistance being formed, they want to take them out because those are acting who act as liquidity for them to actually trigger their orders above and then drop. So our aim is